Good morning. It is Friday, March 22nd, 2019, and I am back from 2 weeks on the road, visiting Manhattan, Phoenix, Albuquerque, with a very brief stop in Houston. A lot of flights, a lot of people trying to infect me, and I think they got me. So I'm going to sound even more nasally and Wisconsinitish than I normally do, as I try to have a little bit of tea to keep my whistle wet. So as you can see on the screen, the new Fundamental Trends website is up. It is still in beta. Still have a lot of content to add, a lot of updating, but I want to show you the services really quick because I was accused of spreading myself too thin, and that is actually just the opposite of what's going on. I'm getting more and more help every day. So first off, a little comparison of some of the things that I do. The margin of safety service at Seeking Alpha is essentially similar to the Intelligent Investor program at Fundamental Trends. It includes a retirement portfolio, a growth portfolio, and ETFs. Over here at Fundamental Trends, I'm also building a 401k alert service, which is super cheap, $99 a year if you buy it separately, to help you with your 401k plan at work. 4, 5, 6 alerts a year probably, depending on the markets and asset allocation. I will be doing asset allocation for free quarterly on this website, but then the alerts when to update your portfolio based on bigger asset allocation changes as they become necessary, which we are going to talk about today because we are either at an inflection point or one more move away from one. So if you are margin of safety investing, you don't need to switch unless you want swing trading, and the swing trading will be over here in this rare portfolio, rare service. So if you want swing trading, let me know. Just send me an email and I'll set you up with a discount code. I'll have a couple of discount codes as I get this started again. I already have like 100 subscribers, but some people want to swing trade, some don't. If you don't want to swing trade, margin of safety investing and the Intelligent Investor program are basically the same. If you want swing trading, you'll come over to Rare. And then, of course, we have the FA Trader website. Whoops, there we go, FA Trader website, where I am the sustainable investing guy. And this is what I consider to be a great add-on service. I think for 30 or 40 bucks a month, whatever this is, you get basically some of the all-stars from Seeking Alpha and some other places. I was in New York with Ave and Eric, and none of the other ones were there. Beth is the one that I actually brought into the service. So she is the tech person over there. And, I get the benefit of all these people's expertise. So, one of them comes up with a great idea. I'm not going to, not share it with you through my other services. The same thing with them. If I come up with something that they think is great, I'm sure they're gonna share it too. So I think what this is a great service as an add-on. All posts, and it's basically a super chat room where we're all putting in some of our ideas. Now, anything that I post here is 50-50, whether it's exclusive or whether it's at Fundamental Trends and Seeking Alpha. The exclusive stuff that I put here is basically a twist on what I do at the other services. So, it's not as if you're getting extra Kirk if you subscribe to this. What you're getting is extra all of these folks, and I think that they're worth it. So, feel free to have this as an add-on service. There's 2 or 3 more analysts coming, but it's a great way to get a lead in to what everybody's doing here. Jeff is great. I've known Jeff for 5 years. I actually subscribe to Bob Niche over at Seeking Alpha. I'll be letting that go and then subscribing to him over here. Lynn, I don't know her, but she's I've been reading her analysis. Very good stock picker. Beth, you want to understand technology? I've already posted some of her stuff at Margin of Safety. Eric and I had some interesting talks while we were in New York about the macro environment. Avi, one of the best technical guys out there. And Jeff, he was a professor. He is a pretty darn good economic analyst. So, for 30, 40 bucks, I'd say, add FA Trader, because you're getting a host of basically all-star analysts over there. So, fundamental trends, margin of safety, similar to the Intelligent Investor Program. If you're at margin of safety, I don't think you need to switch. If you have margin of safety and you want the 401k alert, just let me know. I'll give you a super discount code on this. Basically, just have it as an add-on to margin of safety, because I think that this is going to be worth it. We'll probably give it to you for 49 bucks a year, cheap. Keeping people on the right side of their 401k, I think, is a big deal. All right, so let's talk about the market. Is the stock market topping? Everybody always wants to know that. And there is a chart from Aave. All the white stuff is mine. So I made some adjustments to this chart because I think there's a couple of different paths. And Avi has been talking about the S&P 500 will eventually fall to around 2,200. Now, I have also said that over a year and a half ago. So I said that the S&P 500 would rise up over 300, or over 3,000, probably go to between 3,100 on the low side, 3,600 on the high side. Hard to know how far breakout goes. Then this level here is at 2,200. Avi talks about the same level. He has different reasons for that level. I just look for the giant levels of support. So if you kind of draw a box around that, it's a giant level of support. And then if you draw a line around the double peaks of 2000 and 2007, that's another huge level of support. About 660 on the S&P, on the SPY, about 2,200 on the SPY. So this would be a crisis level. Everything hits the fan. This is just your general recession level. So Aave, while we have different methods for getting to where we're getting, basically showing the same sort of thing. Now, I had one subscriber who's a member of this as well point out that, hey, Avi is saying that we're going to get down to 220 on the SPY. Well, yes, he is saying that, and so am I. So the question becomes, when? And we also even have the same giant lower end range for the super long-term support. So we get to here, 2,200, get way down here, 1,775. I actually think the support's a little bit lower. But basically, we're targeting the same areas. Here's our rally levels. I said 3,100 to 3,600. He is saying 3,222. Could go all the way up to 4,117. So those are broad ranges. So in his wave theory, he's thinking that there's a breakdown to the 2,200 probably this year, and then a giant rally. But this little alt 4, that's another correction level where things could stop. I happen to think that we are going to see this correction, this little mini correction that we're getting like today, and there was hints of it a couple days ago. I think that we're more likely to be in the alt 4 range. I don't think we're going all the way down here. I think that this market rallies in the summertime over 300 on the SPY. We'll see. and then we get that deep correction. So it's a matter of, do we go down and then up, or up and then down? I don't think there's any way to tell. He has outlined both possibilities, and I don't think we know what's right. So when I look at this sort of thing, I want to look at things like money flow, right? And we'll get to this at the end. But let's talk about why the economy is slowing down before we get back into where's the market going. What we know is that Canada is having a problem because their oil isn't making them the type of money that they want it to make them, and that's going through the economy. However, with the price of oil rising, I think this probably turns around in the next quarter or two. The EU, on the other hand, has a problem with Brexit and everything else that's going on over there. Europe's in bad shape. Their demographics are the second or third worst on the planet. Japan is worst, and then China and Europe are next. Hard to know who's worse, and then America. But America has the offset of the millennials, so it's really Japan as horrible demographics, and China and Europe is very bad demographics, and the United States is to the negative side of neutral. So, let's keep in mind the scale of where everybody's at. So, how do regions that have horrible demographics speed up their economy, right? How do they get growth? How do they pay down debt? And we've had this talk before. I don't think that austerity works because psychologically people can't handle it. So printing money is pretty much always the answer. Now, I'm not saying that theoretically it's pure or even that it's the ethical right way to do things. I'm just saying that's what we choose. So we've done it over and over and over again. I don't expect that we'll suddenly change our minds and go, hey, let's all embrace, economist Hayek and say, let's just go through austerity and let the cycle play out and let all the things that should die, because that includes people, and people get very unhappy. They lose their homes. Think about 2008. Think about 2007, 2006. In 2006 and 7, we had all the telltale signs of a bubble. I was out there buying people steak dinners and pasta, telling them to sell their stuff. And I got laughed at, and I even got fired by people. And then the correction came, and it was a massive correction. It was a once-in-a-century event, and hopefully we don't get another one anytime soon. But I think we probably do when all the demographic issues hit 5, 10, 15 years down the road. However, people didn't see it coming. Why? Because they were living high on the hog. Nobody was losing their jobs. So even though their portfolio started to turn over in 2008, hey, they still had their job and they still had their house. But by the end of 2008, not only were the markets crashing, but people were losing their jobs and their houses. And that's when people start to pay attention. And I've kind of given you this anecdotal evidence once before. During December, I talked to as many people as I could about their portfolios at Christmas parties and poker games and at church and everywhere else. I talked to as many people as I could. Hey, what are you doing about your portfolio? What do you think about your portfolio? What do you mean? People ask me, what do you mean? And it occurred to me that unless people are losing their jobs and their homes, they don't pay attention to this stuff too closely. So there's that 20% of us to pay attention really closely. And then you've got another 40% of the population that has something in retirement plans, but they set it and forget it. They look once or twice a year. And then you got 40% of the people that have nothing. So, we're in that 20% that pay attention. But 80% of the population for sure just doesn't pay attention to their money until they have a money problem, lose their job, lose their house, threaten to lose their house, something like that. So Europe's got a problem. Double played that one. Europe's got some problems, and this belongs down here. Germany is having problems, and now we're seeing some crossover in the Treasury bills. The 3-month 10-year and 2-year 10-year. These are classic recession signals where you get this crossover. Will it follow through or will it bounce back? I mean, there are plenty of charts out there that will show you that it'll go like this and then bounce right back. The reason the Fed has become so dovish is because obviously they knew this was happening and they want to, preempt it. And I happen to think that it's a coin flip whether they can. I think that next year a lot of things are lining up for a small recession. I don't think there's a crisis coming anytime soon. I just think we get a small recession. You're pulled back to 2,200 on the S&P, and then you'll have a new administration come in because Trump will not win if the economy isn't very good. He needs a very good economy to win. He knows that. That's why he's doing what he's doing. That's why I'm keeping a close eye on the China deal. He keeps talking it up. I don't know if we get a fake deal or a no deal. The Chinese are starting to push back, which is what I said they would do a couple of months ago. They're stretching things out, which is what I said they would do. They are buying the soybeans, gas, and semiconductors that they need for the next year or two now, ahead of any final decision on a trade deal. So, don't discount the no deal possibility with China or the possibility that Trump just has to take what he can get, in which case I call that the fake deal. But that probably even is good enough for our economy to hang in there. Then it goes back to Europe, Japan, and China's domestic economies. Do they pull the entire globe down with them? I don't know. It looks like they might. One thing to keep track of, and I've put this chart up in the past, is that global trade and recessions are pretty much, they go hand in hand since after World War II. Actually, since World War II. So if global trade continues to be challenged, we're going to have a hard time growing the economy and avoiding a recession. One thing to keep in mind is that supply chains, and I know this is a mundane thing that people don't really think about, but supply chains are moving. And I've talked about this before. The reason why I don't think President Trump's negotiations are all that important in the long run is that supply chains are going to move based on machine learning and artificial intelligence and automation. And the very simple analogy is a robot in China is no more expensive nor cheaper than a robot in America. So the supply chains will move based on where resources are, and America is resource rich, and where the consumers are, and North America is consumer rich. And then you have South America. You saw how President Trump was getting up close to Brazil. You see what's going on with Venezuela. I think the United States, while we will be the global hegemon and project power globally, we're really going to focus on the Western Hemisphere going forward because this is where the resources are. This is where most of the consumers are. We're going to try to get into Southeast Asia, but we're competing with China and India. Europe doesn't offer much growth. There are allies. We can't turn our back on them, but really there's not a lot of economic opportunity for us in Europe. So, focus on where the money is, and like Grandpa always said, follow the money, right? That's a lesson I got since I can remember. So follow the money, and what you're going to find is that supply chains will move to North America and South America, close to the consumers, close to the resources. It won't be based so much on cheap labor anymore because labor rates are equalizing, not only because lower labor price people want more money and higher labor price people are having a hard time getting a raise, but because automation is changing the scope of how labor functions. So being very service oriented is very important, and it's good that the United States is service oriented. All these folks that want to say manufacture, 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 they just don't get it. Manufacturing doesn't really add too many jobs. What adds jobs is servicing all the people who need services. So whether it's healthcare services or engineering or running the machines, at a higher level, right? It's not just add a widget, get a different widget. It's program that computer, make sure that the machine knows what it's supposed to do. So everything is going to be higher skilled. That's a trend that's been going on for 50, 60 years, and services become more important. So we need to understand the nature of the economy that is developing. So where is inflation? Because people would like to talk about inflation with what the Federal Reserve is doing. The only inflation that we've really seen, and even that's leveling off, is in corporate profits, right? So corporations have been able to maintain their margins despite really no visible signs of inflation in the Fed numbers and in the inflation numbers. But profit margins have been staying pretty thick. Why is that? Combination of things. The tax code helped, and the fact that labor is only getting raises at a very low rate. We're not getting big raises. So there's a little bit more uptick in wages right now, but not much. And the companies are able to pass on those costs. I want you to take a look at your cell phone bills. And I bet that in the last year, you have seen some charges on your cell phone bill go up. Did they advertise that when they said, hey, $49 a month or whatever, so you can get unlimited, internet? No. What they did is they took these segregated fees and they bumped them up. AT&T did it. Verizon did it. I'm sure some of the others did it. I don't know what T-Mobile did. But you're seeing nickel and diming across almost every industry out there. Healthcare isn't getting any cheaper. So the rate at which we are seeing our household costs go up are exceeding our raises. And, unless you're going to really tighten up your belt, you're seeing no increase in the amount of money that you're able to save in most cases. Now, again, the people in this group that are listening are probably a little different, but the general population, that's a horrible way to say that. But really you've got 60 to 80% of the people who are not able to increase what they're saving, and any economic shock is going to create that outcry. And we're seeing that from, Cortez and Bernie Sanders. And that's just the way they are. But, the reality is, I was in New York talking to a bunch of people, and from Uber drivers to waiters, waitresses, door people, people who in the movie Fight Club, right? They do those jobs that maybe you and I don't want, or we did when we were younger, and they're struggling to get ahead. So there's going to be ramifications. And one of the ramifications will eventually be that the corporations can't grow their margins anymore. At some point that will happen. I don't know when. I suspect 2021, because again, I'm forecasting that President Trump loses badly or narrowly, but I don't think he wins. And that in 2020, people will fear that the tax code will change and capital gains rates probably are going to go up, and they should, in my opinion, because it doesn't make sense that hedge fund guys, some of my friends, can get a tax rate of 20% even though they're making $1 million a year, right? That doesn't make any sense. So, you can say that it has something to do with capital structures, and you just be repeating somebody's bullshit line, because that's not really how it works. So whether I make $1,000,000 or I make $200,000 or I make $5,000,000, the tax rate doesn't matter to me, right? If I'm making 200,000 now and I want to make $1,000,000, I'm not gonna say, well, gee whiz, I have to pay 10% more in taxes if I make $1,000,000. No, I'll make the damn $1,000,000, right? So, keep those things in mind. But when capital gains rates go up, that will probably cause a lot of big investors to sell, right? Because they want to lock in the lower capital gains rate next year before the capital gains rates go up in 2021. That's part of my thinking when I say 2020 is the year that I worry about. And there's a whole host of other factors. We took a look at that. All right, so that's just your general economics. We're probably heading towards a slowdown. Everything points to it. Can the Federal Reserve loosening up fight it off? I don't know. They could probably keep it from being severe, but the idea that President Trump and the Democrat Congress are going to agree on any sort of stimulus anytime soon, I think is I just don't think that'll happen. So here's a trend that we see that is accelerating. Oil demand is peaking faster and sooner. And again, this is not something that I want to be true from an investment standpoint. This is just an observation that I'm making. So I don't want to get into ideological arguments, and I don't want to get into a fight with people who say, oh, oil demand's going to go up for 50 years. It's not. Oil demand is already topping out, and there's a lot of good reasons for it. So one of those reasons is China. Not only is China writing laws that will prevent them from buying internal combustion engine vehicles, you're really gonna have to be rich in China to buy a gasoline powered car starting in about 2025. But they're already cracking down on it. China has moved their entire fleet of buses, which is the biggest bus fleet in the world, from diesel to electric. They're in the process of doing it now. So if you take a look at some of, I don't know if this article has pictures, but take a look at some of their train stations or their bus stations. They use a lot of buses in China, and they're all moving to be electric. So that's an entire fleet of diesel buses coming offline. India is doing it too. That's a third of the people on the planet between China and India not using diesel-powered buses anymore. I'm in Wisconsin. We're moving towards natural gas. I think we should be doing electric, but the mayor decided to build a trolley that only goes to a few places rather than convert all the buses to electric. I think that'll come to Milwaukee too, because we are a left-leaning city. So you're going to see a lot of cities in America start electric buses, and it's a lot of diesel that doesn't get used. Trucking is also moving towards natural gas and electric vehicles, not the big trucks, but like your sprinters. What else are we seeing with oil? Wyoming, there was just a court case that put a temporary drilling hold on the leases that were sold on public lands at the end of President Obama's administration. And it applies to the Trump administration trying to sell public leases too. So there was just the auction. I didn't see the results, but I read a quick blurb that the auction results weren't very good because nobody really believes that the public lands are really going to get developed. And probably they shouldn't. In Colorado, and the reason I say probably they shouldn't is because we already are running up against limits on developing the private land. So there's no point to move into the public lands until you're done with your private. Zach's is pointing out, or actually you can find all sorts of headlines here. In Colorado, they're changing the laws. It lost on referendum, but the Democrats won the state Senate. I think that's what they call it there. And they are going to limit how the fracking works there. Bigger setbacks, more regulations. What does that all mean? There's this huge shift going on. I like this map because it shows all the solar projects in the country. These are all the major solar projects. When I flew over the country, I tried to take this picture from the airplane, but I couldn't. I got one picture of a wind farm. I don't remember what I was flying over. I think I was heading to the East Coast. But there's wind farms all over the place going up. But the solar developments, and I talked about this last year when I was at the World Series of Poker, and I went from Arizona to Nevada. I mean, it's just unbelievable how much solar is going on. So that means that the shift that I've talked about, where 100% of all new electric generation in America has been alternative energy for 3 years now. Now, that doesn't mean that there's no natural gas taking the place of coal. There is. But on net, fossil fuels have been level because coal's going down, natural gas is taking part of that. But the new generation we need as we electrify the economy has all, 100%, all net new power generation in America has come from alternatives. About 2/3 wind, about 1/3 solar, and those numbers are looking to flip over here in the next 2 or 3 years. So solar is a big deal. That means inverters. That means a smarter grid to handle the intermittent power, batteries. It's all the things that come with that. Tesla, is joining up with Apple to really start to go out and protect some intellectual property rights. Now, and that's interesting because Tesla gave away a lot of its patents, but there's certain stuff they want to keep. And why is this important? Because they see how big the pie is. As we convert the auto fleet to electric over the next 20 years, think about going from zero to most in 20 years. And it's a lot of money that's going to be made. That's a huge S-curve. GM, right? GM is looking to make electric investments soon. And I think they're going to move it up a little bit, because Trump is on their back. But, they were moving in this direction anyway. You've heard me talk about Ford, makes sense for Ford to try to take over Tesla. I guess it would make sense for GM to try to take over Tesla too. So they're all moving in this direction. Volkswagen, right? Everything at Volkswagen and Volvo are going to be electric or hybrid in the next 3 or 5 years, they're saying. I think they're saying 3, it'll probably be 5. So, and this is just something to keep in mind because we have covered the car industry, and Dave and I have minor disagreements over the way that's going to go. But fuel cells probably don't work in cars. Just logistically, it doesn't work well. What we're probably going to get is a lithium-like replacements, right? So we have the lithium cells right now for cars. We're just going to find a better way of making those cells with a different material, probably zinc. Zinc air is probably the way it's going to go. We already have the technology. Just has to be moved up the manufacturing scale. So when I talk about oil demand is peaking faster and sooner, it's not a hard to make prediction. So what does that mean for our oil stock trades? It means we're going to have to take our profits, and then they're not buy and hold forever stocks anymore. So when I talk about Exxon and Chevron having big troubles in the next several years, you can take that to the bank. They don't have anybody they can sell their excess assets to. They're never going to be able to maintain their dividends and pay down their debt. And at some point, Saudi Arabia makes it very clear that they are going to pump as much as they can. So the charts that I've put out there that point to 2030-ish being the point where oil demand starts to shrink, I think used to be fairly aggressive. I think they're spot on right now. I might even start to agree. We'll see how fast things move in the next 5 years, but we might see peak oil demand at about 2025. That is when BP and Royal Dutch Shell put on the short side of their windows when they did their projections. So you can go to Royal Dutch Shell, you can go to BP, and they have the outlooks. And they're saying sometime between 2025 and 2040 is when peak oil demand occurs. I think it's between 2025 and 2030. I lean towards 2030 just because, we take our time making certain changes. But we'll see how the elections go in 2020. It could be faster. So we have to keep that in mind when we're investing. Oh, already did that. So this investment firm, Ciavaco, I have a couple of subscribers that really follow this guy closely, and I think he's one of the other top technical analysts out there, along with Avi. And he did a video this week that I recommend you all watch. So go to his article in Seeking Alpha. The S&P 500 setup has only occurred one other time in the last 70 years. Ciavaco. So go to his article, and then you can go to his video, which he has embedded. And it talks about how it looks like there's a breakout, not a breakdown coming in the S&P 500. Again, that goes back to this idea. Do we get a fall and then a huge rally, or do we get a little rally and then a bigger fall? I think it's a little rally and a bigger fall. Avi's leaning in this direction, a correction and then a big rally. I don't know, but if we start to get the correction soon, you're going to want to take a lot of profits and get all your leverage off the table quickly, right? We took our leverage off too slowly in the fourth quarter. So if we start to get that type of correction again, you want to get your leverage off like as fast as you can, because those will be the places where you get hurt the most. He makes the argument that it looks more along the lines of what I'm talking about. He looks for more of a rally and then down the road a breakout or a breakdown. So I'm going to stick with my crash 2020 prediction. If you do go on Twitter once in a while, go ahead and put search Twitter pound crash 2020, and a whole bunch of those will be mine. So go ahead and follow me on Twitter, and every now and then, let's see, I don't know, somebody's adopting. Yeah, and some other people use Crash 2020 too, but it's a good hashtag. I'm going to attach a lot of stuff to it in the near future. Since we're on social media, there we go. If you want to follow on social media, I got a Facebook page too. It doesn't get updated as much as it should. Sometimes the extensions that push Twitter to Facebook work, sometimes they don't. So I'd say follow me on Twitter if you want to get more of my quick thoughts. All right, so let's take a look at what's going to work in investments here. The quants are trying to go after low volatility again after a little bit of a pullback. I don't know if that's such a good idea. One of the things that I talked to Bob Savage about in New York, who he'll be on the show here in the next several weeks, is that if you really think things are going to fall and the technicals confirm it, or the quantitative analysis confirms it, don't take a defensive position in stocks. Stocks are mostly correlated. When some stocks go down, most stocks go down. While there's some rotation in up markets that you want to get a part of, when the market is falling, the market's just falling. Get out. I can see being 75% cash by next January. I don't know that I want to do that now, but if we do get, right, if Avi's first scenario plays out, his second scenario is that what I'm saying happens, right? He leans towards this scenario. If this starts to happen in the next couple of weeks, just get out, right? Just get out because it's going to go pretty far. And then you buy down at 23, 2200 and you get back in. And the easy way to do that is just buy SPY, right? Or buy QQQ. So let's take a look at some of these money flow issues. This is a daily chart, and we can see that daily money flows have fallen off of an extreme. However, and I actually already have it up, we can see that money flow on a weekly basis has been going up and just turned over. So it wouldn't be unusual for this to be a temporary pullback and then to rally again. Now, it wouldn't be unusual for it to do this either, right? So what we have to determine is, are we going to get this, or are we going to get a rally? We're going to know that in the next couple of weeks. The daily on the QQQ has been holding up, and the weekly has been holding up. But again, you know, that's a warning sign. So is that a pause that refreshes? Or is this a harbinger of down? We'll know in the next couple of weeks. Oil, right? Rally after the bottom, a breather. And now looks like, where's my weekly chart? And now again, same thing. Is this a temporary pullback, pause that refreshes, or are we going to see it tip over again? Again, the next couple of weeks will be telling. So, I'm dying here. Let me take a couple questions if there are any. Next week, week after, we start doing the interviews. I have 3 people lined up, and we're going to talk some cryptocurrency. We're going to talk Federal Reserve. I don't know what I'm going to talk about with Bob Savage. I'm going to try to get Dale Pinkert on. So in the future, the shows are going to be 20, 25 minutes me, and then a second show, basically 20 to 25 minute interview, hopefully starting next week. All right, any questions? Yeah, Eurozone PMI, bad number. Europe might be on the verge of recession, right? I mean, they could actually already be in a recession. So, as I just stated, I don't know that we know which way things are going. But if you take a look at certain holdings, right? We sold cash secured puts on Micron, what, a month ago? And if you close those positions right now, you're probably making 5, 6, 7, 8 points in a month. Now, you can't make 5, 6, 7, 8 points on cash in a month or two, right? So there are certain cash secured puts I think you should be closing. Take a look at the duration. If they're pushed all the way out to May and June, you're more likely you want to close those, but the time value might prevent you from doing it. Some of those April puts, you know, you got 3 weeks, 4 weeks to go on those. You may want to close those because the time value is deteriorating already. And the only bad thing that could happen is a sharp drop, and then you get the stock. You might just want to take your money. I'm right around 20, 25% cash, but that's normal for me. So again, I tell people over and over again, the only time to be really fully invested is after a big correction. And I got fully invested that last week of December, and I've done minimal trimming so far. I know a number of folks out there have told me that they've been doing major trimming. I think that's a little quick. You might be lucky, you might be getting lucky. And there's something to be said for luck. But if you're trimming because that's your risk tolerance, that's fine too, right? So I tend to be pretty middle of the road on everything, even including investment strategy. So if you're a little bit more aggressive, you leave a little bit more on. If you're a little bit more conservative, you take a little bit more off. Somebody here on the board says get out of financials. I'm not in financials, with the exception of PayPal. That's my version of a financial. I don't like the banks in general. JP Morgan is the one that I would take a look at buying at some point if I could get it cheap. But I think cheap is, down in here. So when we take a look at our stocks on our list, you can see there's not a lot of our stocks are in the buy zone. We've got, Texas Instruments, you can start taking a look at. And that doesn't mean buy. It just means, okay, it's at a price where I need to take a closer look. Floor, I really think Floor is going to be a great buy when the next recession comes. Why? Because they'll probably go down to 20 something, and they'll be a big beneficiary of an infrastructure bill. It's not here yet. You got to be patient. Greenbrier, I've been following them for years. I just don't have my head completely wrapped around what their growth opportunities are. Calavo Growers, I probably can get rid of them. I bought them real cheap. I don't know. These are avocados. It's avocados. Talk about boring investments, right? It's an avocado grower. They've pretty much maxed out based on where they can be. Some of the energy stocks still look pretty attractive to me. Why? Because the Saudi Arabians are guaranteeing that the price of oil is going to go up. And Russia's on board there too. Russia's not cutting, but they're not reinvesting into more drilling. So that just means that they'll naturally peter out a little bit. They're holding their drilling level to slightly, it's falling just a little bit. As far as refiners go, here's a free one for you. I think Marathon Petroleum is worth a pretty good look because they have a lot of the light sweet crude refining capabilities, and they're lined up pretty good for the ISO 2020 in the second half of this year. So I put up an article out of Barron's that I largely agree with. Marathon Petroleum is my first choice, and then Phillips is my second choice. And I don't even have Phillips on here. So we were in Phillips, so here's where we do pretty good once in a while, right? So we were in Phillips 2.5 years ago, maybe. We bought it in here. And then in January, February, I think we sold it here. Right around here is where we sold it. And then it fell. It went up again, then it crashed. So I've a couple times told people to sell PSX. So we bought it in the 70s, sold it around 100, and now it's back down to where we sold it. And does it have one more drop? I don't know. Maybe I should have bought it again here. I didn't. But if we get one of these little corrections, if Avi's leaning towards happens, and we can get this to fall, man, I sure like this down here. Same thing, MPC has ran a little bit, right? But it's closer to its bottom. Nice double bottom here. If you get a pause here, I think MPC is the one, right? Get a nice run there. Pay a little bit of dividend. I don't emphasize the dividend so much because, again, I don't think this is a buy and hold forever. Something that I would buy and hold forever for the dividend, you got Intel. I'd rather have Intel on a pullback than any of those oil companies. Because Intel, in the smart everything world that's emerging, this dividend probably gets stronger. The stock probably goes higher. Another one, as they add more subscription services and more smart home and things like that. I think Apple. Apple is another one that's off this bottom. I mean, I hope when I was telling people to buy Apple around 170, I hope you were buying it, right? You did all right. So, I'm not trimming energy yet. I've been saying we're so the end of the year people completely don't understand. And I have talked about it over and over again. You must read this article and understand it. This is what happened in the fourth quarter. There were massive amounts of money that were coming out of the market. That's it. Stocks are supply and demand driven. Every financial asset is supply and demand driven. When more money is chasing an asset, it goes up in price. And when money is coming out of the asset class, it goes down in price. There's a rotation into a lot of assets that we are getting a pause on right now. We'll know in the next few weeks if Avi's option 1, which is a correction down to 2300, is going to happen this year or not. I don't think it will, but I'm not real convinced. It could, and then maybe we get that double dipper. Like I talked about a double dipper session, last year? Maybe that's what happens. We'll see. There's a lot of weakness underlying the economy, but the central banks already are getting more dovish. It is unusual that the central banks preemptively get dovish. They usually wait for the bad stuff to happen, but they didn't do it this time. The Federal Reserve got dovish way ahead of any bad things happening. They announced this week that they were going to end the quantitative tapering by September. You know what that tells me? They probably end up doing it even sooner. Or they start to do it sooner. And that means there's going to be $50 billion a month not coming out of the economy. That's a lot of money. If the year ends up being positive, you won't get hedge funds selling at the end of the year like you did last year, and you won't get tax loss selling. There's a lot of reasons why this could be a strong year. We need to wait on China, but there's just not a lot of negatives out there that are so strong that they would offset the money flow into the market off of the bottom at the end of last year. Next year, however, a lot of things could peter out. Corporate profits could stop going up. People who want to lock in capital gains will start to sell. The China deal, which will end up being a fake deal or a no deal, could have an impact. Hedge funds rarely have 2 good years in a row. They could be sellers at the end of next year. The second half of next year could be pretty horrific for investors who just set it and forget it. I don't see anything horrific in the short term. If we do get this pullback to 2300 in the next couple of weeks, I think we're going to know if that's where we're headed. Then I will get rid of all my leverage and raise a whole bunch of cash, and I'll do it quickly. And then when we get down to 2300 and everybody talks about, oh, that's overdone, right? So the market rallies off of this bottom in December, and now you got the traders going, oh, it's overdone, it went up too fast. Well, they were loving the correction because they're like, oh yeah, we got short at the end. Whatever. They're just talking their book. Understand that money moves the market. Go read more about Shaken. He's right on it. MACD, he's right on it. Those guys are still alive. They have websites. And if you follow the money, you will know what's going to happen. And right now, there is not a big outflow of money. We'll see what happens after the annual retirement plan contributions are done in April. Yeah, I haven't even looked at the MU earnings yet. How invested should we be in the 5G theme? 25 or 50%? Oh my God. No. I've got like 12% of my money in things that are remotely related to that between the telephone companies and Sierra Wireless. Yeah, I use SciCam. I think it got too late this time. Yeah, I mean, I like Sierra Wireless. I think it's a good place. All right. I think we're good. Take a look at the rotations that are going on, but pretty much stick with good mid-cap companies are where you're going to find your growth. Your stability is going to come from some of the big, low capital intensive companies, right? Low capital intensity. You don't want companies that have to add a lot of money to create a lot of money. That's one of the reasons we're looking for our exit on oil. At some point, even with higher oil prices, it's just not going to work. Tesla, you know, I told everybody to get out of Tesla when it was over 300. That article got me mocked. It's down to 265. All right. So in the very short term, Tesla's getting crunched. And it's hitting an extreme for money flow on the weekly. So it's really gotten beat up. It's very close to being a buy. Another week or two. If this market isn't headed into a big correction, Tesla might be a buy in a week or two. If it is heading into a big correction, maybe we get our dream price on Tesla at 170 again. That would be beautiful. All right, I'm going to let you go. Time is up. Next week, we start having guests. Everybody take care. Go gargle, have some Zycam, whatever it is you're supposed to do when you have this type of a cold. Take care, everybody. Have a great weekend.